All right, so today we're going to dive into this whole world of volatility trading. Um, More specifically, we're going to be looking at this ZIVB ETF.
Okay.
Have you ever heard of this?
Yeah, I have. It's an interesting one, to be sure.
Yeah, it seems pretty interesting. I was doing a little reading on it beforehand, and it kind of seems like, when people bet on like how dumpy a car ride's going to be, like most people are going to be like, oh, it's going to be a super wild ride. This is like the ETF that's like, no, no, no. It's going to be smooth sailing. It's going to be totally calm.
Yeah, it's definitely going against the grain a little bit. You see, most volatility-focused investments are trying to make money when the market is going crazy, when
Yeah.
it's experiencing a lot of turbulence. ZIVB is designed to make money when things are kind of, chilling out a bit.
So it's kind of like betting against a market meltdown.
That's one way to think about it, yeah.
So how does that even work? Like, how do you actually bet on calmness like that?
Well, it all starts with something called the VIX. You've probably heard of this. It's often called the market's fear gauge. Basically, it's measuring how much volatility investors expect in the S&P 500 index, over the next 30 days. So it's a forward-looking kind of metric. Think about it like this. When investors are nervous, like they don't know what's going to happen, they're uncertain, the VIX is going to go up, right? But when everybody's feeling good, feeling confident, they're anticipating smoother sailing ahead, the VIX is going to go down.
Okay, so if the market's expected to be like a roller coaster, the VIX goes up.
Exactly.
And then if it's going to be like watching paint dry, it's like
VIX plummets.
it plummets. Gotcha.
And ZIVB, this is a, NIX 1X short ETF. What that means is it's designed to make money when the VIX goes down.
Okay, I get that it's short the VIX, but what does that mean in practice? Like, how does it actually try to make money from a calmer market?
So this is where it gets a little bit technical.
All right.
ZIVB is trying to benefit from something called contango.
Contango.
Yeah, contango. Now imagine the VIX futures curve. Imagine that's like a slope, okay?
Mhm.
So in contango, the slope is upward. So that means the longer-term VIX futures, they're pricier than the shorter-term ones.
Okay.
ZIVB is essentially betting that this slope, this contango slope, is going to flatten out, that those prices are going to come closer together.
So they're riding the slope down.
Exactly.
Okay.
And this tends to happen when the VIX is relatively stable.
Okay.
So again, indicating lower expected volatility in the market.
So lower volatility, VIX goes down, they make money, contango flattens.
Gotcha. Now, it gets even more interesting. Unlike some other volatility ETFs, they focus on those really short-term VIX futures contracts, like 1 to 2 months out. ZIVB is looking further ahead. They're looking at the midterm futures, specifically 4 to 7 months out.
So that's really interesting because from the research that we have, it seems like that, that midterm focus is kind of like, I don't know if this is a good analogy, but like having a car with better suspension. Like you're still going to feel the potholes. It's not, you're not going to feel them,
Yeah.
but it might be a little bit of a smoother ride overall.
I think that's a really good analogy, you see, because the first couple of months of that VIX futures curve, that can be a wild ride. It can be very jumpy, up and down, really hard to predict.
Oh, I bet.
So by focusing on those later months, ZIVB is hoping to kind of smooth out some of that volatility.
So it's not that they're immune to losses, though, right? Like even with a better suspension, you can still hit a pothole, and it's gonna, throw you for a loop.
You're absolutely right. So while focusing on those 4 to 7 month VIX futures might, reduce volatility, it's really important to remember that ZIVB can still experience losses, especially during any kind of market shock, like a black swan event. Even those longer term futures, those aren't immune to price swings.
So it's more like choosing a slightly less bumpy ride, not a completely smooth one.
Yeah, exactly.
Okay, that makes sense.
Yeah.
So that's like kind of the theory behind it. How's it actually performed, though?
So it's important to keep in mind this is a really new ETF.
Okay.
It just launched back in April of this year.
Oh, wow. So it's very new.
Yeah, very new. And it's still pretty small, too. It's got, as of a couple of days ago, just over $15 million in assets under management.
So it's kind of early to tell how it's really going to do over the long term.
Yeah, way too early to make any kind of definitive judgment. And it's also got a fairly high expense ratio, 1.35%.
Okay. Yeah, that's something to keep in mind.
Definitely.
So I know you always say past performance isn't necessarily indicative of future results or whatever, but how has it done? Like compared to, you said it's tracking the S&P 500 VIX midterm futures inverse daily index.
Right. And so through the end of last quarter, ZIVB saw a return of negative 9.87%.
Okay.
The index returned to negative 9.72%.
Okay, so pretty close.
Very close, yeah. Very close. And if you look at the performance since its inception, ZIVB sits at 61.29%. The index is at 58.8%. So really, it's doing what it's supposed to be doing. It's tracking that index pretty closely.
Yeah. Now, from what I've seen, and maybe I'm wrong here, but it seems like, those returns, they're more muted compared to some other volatility ETFs out there.
Yeah.
Like the ones that are a little more, what's the word, aggressive.
Yeah, I would say that's fair. But you have to remember, with those riskier ones, those more aggressive ones, they might have the potential for bigger gains, but they also have the potential for much larger losses.
So higher risk, higher reward, that whole thing.
Exactly. Volatility trading is inherently risky, and ZIVB is not some kind of exception to that rule.
Right. And it's a leveraged ETF, so it can magnify losses, especially during periods of, well, high volatility.
So, precisely. So, yeah. Even though ZIVB is designed to benefit from those calmer periods, investors really need to understand what they're getting into, because it's not a sure thing.
It definitely sounds like something where you really need to know what you're doing.
Yeah, you really have to have your head on straight going into this kind of trading. It's not just like, throwing darts at a board.
Yeah, it seems a little more involved than that.
It definitely is.
So we've talked a lot about, how ZIVB specifically is trying to do this whole, profit from lower volatility. But I kind of want to zoom out a little bit.
Sure.
And talk more generally, like, what are some things that people should keep in mind if they're considering this whole, like, volatility trading as, like, an investment approach?
Yeah, that's a good point. We should zoom out a little bit. So I'd say the first thing, and this is probably obvious, but volatility is just inherently unpredictable.
Yeah.
I mean, it's affected by a million things. You've got economic factors, geopolitical events, even just like investor psychology.
It's not like predicting the sunrise.
It is not, unfortunately. No, you can make educated guesses, but you can't say for sure what volatility is going to do. So that's like step one. Just accept that you can't predict it perfectly.
Okay, so accept that going in, that it's going to be unpredictable.
Exactly.
Gotcha.
What else? The other thing is diversification.
Okay.
It's not just some like investing buzzword.
Yeah.
It's really important. You don't want to put all your eggs in one basket, especially with something like volatility trading.
Right, so even if you, like, really believe in the whole ZIVB strategy or whatever, you wouldn't want to just put all your money in that one ETF.
Right, exactly. You want to spread your investments around different asset classes, different sectors, even different investing styles, so that, if one area does badly, it doesn't chank your whole portfolio.
Yeah, that makes sense. Okay, so we've got those. What else? What's another important concept when you're talking about volatility trading?
Well, we've talked about contango, which is what ZIVB is trying to profit from. But there's kind of a flip side to that, and that's called backwardation.
Backwardation? That sounds kind of scary.
Yeah, it just sounds a little intimidating. Basically, backwardation is like the opposite of contango. So instead of the longer-term VIX futures being more expensive than the shorter-term ones, it's the opposite. The near-dated VIX futures are trading at a premium to those longer-dated ones.
Okay, so can you give me, like, an example of when that might happen?
Yeah, so imagine, like, a major geopolitical event happens, something totally out of left field, or there's some huge economic announcement, something that just throws the markets into a tailspin. Investors get scared, they rush to buy protection, and suddenly those near-dated VIX futures, those are in high demand. Everybody wants them because they're worried about what's going to happen in the immediate future.
So, like, everyone's running to buy insurance because they think there's going to be a hurricane tomorrow.
Exactly. And because ZIVB is short, those midterm VIX futures, if backwardation happens, that could hurt them.
Right, because those contracts they're betting against could suddenly get more expensive. Okay, that makes sense.
Yeah.
So it's like a constant balancing act, right? Trying to figure out if contango or backwardation is more likely.
It is, and that's part of what makes volatility trading so challenging and also potentially rewarding, You're really trying to anticipate how the market's going to feel about risk, not just what's happening right now.
Yeah, it's like you're trying to read the market's mind almost.
In a way, yeah.
Okay, so say somebody is thinking about getting into this. What are some, like, key questions they should ask themselves?
Okay, well, first and foremost, they have to think about their risk tolerance. Because volatility trading, it can be really volatile.
Yeah, no kidding.
Like, you can make money, you can lose money, and it can happen really fast.
So are you saying this is not for, like, the casual investor who just, like, checks their portfolio once a year?
Probably not the best idea. No, you really have to be comfortable with the ups and downs, and you have to understand that, sometimes you're going to be swimming against the tide.
So it's not like a smooth ride. even if ZIVB is aiming for that with its strategy.
Yeah, exactly. Even if their strategy works perfectly, there's still going to be bumps along the way.
So you got to have the stomach for it.
You do.
Okay, so that's risk tolerance. What else? What's another important question?
The other thing is, how comfortable are you with the idea of potentially making money when the market's doing badly? Because volatility often spikes when the market's going down. So if that makes you uneasy, then volatility trading might not be the best fit.
Yeah, it's not for everybody, that's for sure. It's like, when everyone else is freaking out, you have to be the one who's like, okay, cool, this is my time.
Exactly. You
Yeah.
can't get caught up in the emotion of it. You have to have a plan and stick to it.
Okay. So we've talked about risk tolerance. We've talked about being okay with, potentially profiting when everybody else is panicking.
Mm-hmm.
What about, like, more of the, I don't know what the word is, but, like, the actual mechanics of volatility trading?
Sure. So if you're looking at a specific instrument, like ZIVB, for example, you really want to understand what you're buying. Look at their holdings, how they track the index, what are their fees, that kind of thing.
So it's not enough to just be like, oh, volatility sounds good. You have to actually do your research.
Exactly. You have to understand how the sausage is made, read the prospectus, look at those expense ratios, think about the tax implications, all that boring stuff.
Yeah, nobody likes to read the fine print, but it's important.
It really is, especially with something as, potentially complex as volatility ETFs.
Okay, so you really do have to know what you're doing. Before we move on, though,
Yeah.
can we actually walk through some examples? Like if contango happens, what does that look like in the real world? And then what about backwardation?
Yeah, sure. So let's say there's I don't know, some big geopolitical event.
Okay.
Like suddenly there's tensions erupt in some part of the world that's really important for, the economy or whatever.
Mm-hmm.
So, big surprise. Markets don't like surprises. Uncertainty spikes.
Right.
The VIX, it shoots up.
Yep.
Because investors, they're worried, right? They see trouble on the horizon. So what do? They start buying up protection. They're looking for ways to hedge against losses in case things really go south. And a lot of times that means they're going to be piling into those near-dated VIX futures contracts. They want that insurance, right now. And because those contracts are in such high demand, their price goes up.
So that's backwardation happening, right? Those short-term VIX futures are getting more expensive than the ones further out.
Exactly.
Okay.
Investors are basically saying, we're willing to pay a premium for some peace of mind right now. And an ETF like ZIVB, well, they're short those midterm futures, so this kind of situation, it can hurt them.
Because the thing they're betting against is getting more expensive.
Right.
Gotcha. Okay, so that's the negative scenario, I guess, for ZIVB.
You could say that, but let's flip the script.
What?
Let's imagine that things are actually pretty good.
Okay, so good economic news.
Exactly. Inflation is cooling off, consumers are still spending money, companies are posting strong earnings, everybody's feeling good.
Okay, so the vibe is good. Gotcha.
The vibe is good. That's
Yeah.
a good way to put it. And in that kind of environment, well, the VIX is going to go down. Less fear in the market. Investors are feeling more confident. So they're not in a rush to buy that volatility protection. They're not so worried about the market taking a sudden nosedive. So in this scenario, what you often see is that the VIX futures curve, it starts to slope upwards.
Okay.
And that's contango. And remember, that's exactly what ZIVB is hoping for.
Right, because they're betting that those longer-term contracts will be more expensive. So they make money when contango widens like that.
Exactly. That's how it's supposed to work.
Okay, so it all comes back to what's going to happen with the VIX, which, as we've established, is pretty much impossible to predict with any certainty.
Yeah, and you also have to remember ZIVB is still very new.
Oh, yeah, that's true. We said it launched in April, right?
Right, so it hasn't really been tested by, a major market event yet.
So it's kind of like we've only seen it sail in calm waters so far.
Yeah.
We don't really know how it's going to handle a storm.
That's a good way to put it. So, I'm not saying it's a bad investment, but I am saying that investors should be aware of that.
It's like if you're going to get in a boat with somebody who's never sailed before, you'd probably want to know that going in.
Exactly. You'd want to be extra careful, maybe wear a life jacket,
For sure. All right, so to kind of wrap things up here, we've talked a lot about ZIVB. What are the big takeaways here?
I think the biggest one is that volatility trading, it's not for everyone.
Yeah, definitely not.
It's more complicated than just buying and holding an index fund. It's riskier too, but it can also be a lot more rewarding if you do it right. But you really have to know what you're doing. You have to do your research, understand the risks, and be prepared for anything to happen. Yeah.
So it's not a get-rich-quick scheme, that's for sure. It's more like, if you're going to play this game, you got to be ready to play for the long haul.
Yeah, exactly. You got to have a plan, you got to stay informed, and you got to be able to adapt when things change, because they will change.
Well said. All right, that's about all the time we have for today. Hopefully this was helpful for anyone out there who's interested in ZIVB or just volatility trading in general. As always, do your research and don't invest more than you can afford to lose.